Hi, my name is Dr. Annette Moultrie, and this is Accounting 101. So, let's see what we will teach in this video. But before we proceed with the video, I need you to click on the subscribe button. Click on the thumbs up button below. Also, click on the notification bell so you'll be notified of upcoming videos. So here we are with Learning Objective 3. Learning Objective 3 will describe the accounting equation, define assets, liabilities, and equity. The accounting equation, it measures the resources of a business, what the business owns or has control of, and also the claims to those resources. And they are what the business owes to the creditors and to the owners. The accounting equation includes assets, liabilities, and equity. Assets appear on the left side of the accounting equation, and liabilities and equity appears on the right side of the equation. So you have to remember that the accounting equation is an equation. So the left side of the equation always equals the right side of the equation. So what is an asset? Assets are something of value. It's something of value a business owns or has control of, such as cash, merchandise inventory, furniture, or land. Liabilities are claims to assets. Claims to assets come from either liabilities or equity. Liabilities are amounts the business owes. They represent the creditor's claims on the business assets. Many liabilities have the word payable in their titles. For example, accounts payable, notes payable, salaries payable. All of these are liabilities. Equity, it represents the amount of assets that are left over after the company has paid its liabilities, which is the company's net worth. Now, equity increases with owner contributions and revenues. Owner contributions to a business are referred to as owner's capital. An owner can contribute cash or other assets such as equipment, furniture to the business and receive capital. Equity is also increased by revenues. Revenues are earnings that result from delivering goods or even a service or services to customers. Examples of revenues are sales revenue, service revenue, rent revenue. All of these are revenues, examples of revenues. Equity decreases with expenses and owner withdrawals. Okay, so what are expenses? Expenses are the costs of selling goods or services. So expenses are the opposite of revenues and therefore decrease equity. Some of your examples of expenses could be your rent, salary, advertising, utilities. These are examples of expenses. Owners' withdrawals or drawings, they are payments of equity to the owner or to the owners. Withdrawals are not expenses. They're not expenses. An owner may or may not make withdrawals from the business. Owner withdrawals are the opposite of owner's contributions, and therefore it decreases equity. The accounting equation is expanded to show the changes in equity due to contributed capital, dividend payments, revenues, and expenses. When the revenue or revenues exceed expenses, the result is what we call net income. On the other hand, when expenses exceed revenues, the company will have a net loss. So it's always good for businesses to strive for net income. Okay, so we've ended learning objective 3. Now we're getting into learning objective 4, in which we're use the accounting equation to analyze transactions. Use the accounting equation to analyze transactions. So how do you analyze a transaction? How do you analyze a transaction? Well, first of all, let's define what is a transaction. A transaction represents the activities of a business that affects the company's financial position. Only events that can be measured in dollars are recorded as transactions. Therefore, meeting a potential customer and hiring an employee are business events, but they are not transactions from an accounting perspective. For example, we see here, is it a transaction? Buying a computer for the office for $2,000 cash. Of course, it is a transaction because it can be measured in dollars. Hiring a new employee. No, this is not considered a transaction. Using the accounting equation, we have this company that we will be following, Smart Touch Learning. Here you see Smart Touch Learning recording accounting transactions. In this example, you see here, Smart Touch Learning Smart Touch Learning receives $30,000 cash from the owner. And the owner is Sheena Bright. And the business gave her capital. So in this example you see here, cash and equity both increase because you have $30,000 in cash, and then you have capital. Again, the accounting equations, assets equal liability plus equity. The left side of the equation is the cash, the $30,000. The right side of the equation is the $30,000 equity. Okay, so an increase in cash will be an increase in equity on the right side of the accounting equation. So the accounting equation must be in balance. The left side must equal the right side. Here in this transaction, the company purchases land. They purchase land for $20,000 cash. Now in this case, cash is decreased by $20,000. At the same time, land is increased by $20,000. So they're both assets. You have the beginning $30,000, but the company purchased $20,000, which leaves $10,000 in cash But you have the land that the company purchased at $20,000. So the $10,000 cash you still have and the land that you purchased, they equal to $30,000. So you see the asset is still $30,000 and your equity is $30,000. Here in transaction 3, Smart Touch Learning buys office supplies for $500. Rather than require Smart Touch Learning to pay for the supplies at the time of purchase, the supplier has offered them to pay later, 30 days later. So in this case, office supplies is an asset. It's not an expense, it's an asset because the supplies have not yet been used. So you create a payable, and your payable is a liability. So again, you have the $10,000 cash. The company purchased supplies, $500. Then you have your land at $20,000. Okay? Because the supplier is allowing the company to pay later, it creates an accounts payable account. Okay? So with this company, you have your $10,000 cash, office supplies, $500, and then you have your land. $10,000 plus $500 plus $20,000 will give you $35,000. And here you have on the right side the liability, $500, plus owner's equity, $30,000. So assets, $35,000 is equal to liabilities plus equity. $35,000 is equal $35,000. So you see that the accounting equation, assets equal liabilities plus equity, is in balance. Here in transaction 4, the company provides training services to customers. The customers pay cash for the services. So cash is going to increase. The customer paid $5,500 in cash. So your cash has increased to $15,500. You still have the $500 in office supplies, and then the $20,000 land. Here you have accounts payable, the $500, owner's equity, you have the capital of $30,000 plus service revenue, $5,500. So you see that the equation, the accounting equation, is balanced. In transaction 5, there's earning of service revenue on account. In the previous slide, you saw that the customer paid cash, but in this scenario, there's an account, whereas they're paying not upfront but later. Okay, so Smart Touch Learning performs a service for clients who do not pay immediately. The clients promise to pay $3,000 within 1 month. So that promise to the asset is an accounts receivable. It's an accounts receivable. So because the customer is not expected to pay for a month, accounts receivable instead of cash is recorded as an asset. Here you see the $15,500, the $3,000 that the customers will pay later. You still have your $500, and then there's the $20,000 land. Now, future payment from the customer is expected. Therefore, the accounts receivable is an asset. The revenue is earned because Smart Touch Learning has performed the service. So notice that the term on account can be used to represent accounts receivable if cash will be received in the future, or accounts payable if cash will be paid in the future. Here in transaction 6, payment of expenses with cash. Smart Touch Learning pays $3,200 in cash expenses, $2,000 for office rent, and $1,200 for employee salaries. Each expense is recorded separately and decreases equity. Cash is also decreased. So here you see in this example, the $3,200 where the company pays for expenses. Okay? You have so that will actually decrease your cash. So now cash is at $12,300. You have your accounts receivable, plus the office supplies, plus the land. These are all your assets. Cash, accounts receivable, office supplies, plus land. Your liabilities are accounts payable. Or should I say is accounts payable, which is the $500. The equity is the capital, $30,000, service revenue, $8,500. The company paid $2,000 for office rent, and they paid $1,200 for salary of an employee salaries of $1,200. So you have your assets equal liabilities plus equity. Your accounting equation is in balance. In transaction 7, there's a payment on account. So remember when we said when there's a payment on account, it is considered accounts payable. In this scenario, Smart Touch Learning pays for part of the office supplies that it purchased on account back in transaction 3. So, because the company is paying a portion of it, which is $300, it's going to reduce cash. It's reducing the amount that Smart Touch Learning owes to the supplier. Okay? So again, you have your assets, cash, accounts receivable, office supplies, and land. This is where you see the $300 that was paid on the account, which brought your cash balance to $12,000. And you'll see there's $3,000 here in accounts payable, where it's reducing the liability. So at the beginning was $500. Now the liability is $200. That's the remaining balance on account. You have your equity, capital, service revenue, rent expense, salary expense. In transaction 8, Smart Touch Learning collects $2,000 from the client to whom services were provided in transaction 5. Here you see the $2,000 that the company collected from a client. Now cash is increased by $2,000. So the balance in cash is $14,000. Notice that while cash increases, the amount owed to Smart Touch Learning from the customer declines or decreases by the same equal amount. So here you see the $2,000 was collected from the client. Now accounts receivable decreases by $2,000, the same amount. So you have the cash increase, and then you have the accounts receivable decrease, office supplies, and land. All of this is your assets. And of course, your assets is equal to your liabilities plus equity. In transaction 9, there's a withdrawal of cash by the owner. The owner in this case is Sheena Bright. She withdraws $5,000 cash from the business. So cash and equity decrease. Here you see the cash is decreasing. Now the balance in cash is $9,000. Accounts receivable is at $1,000, office supplies $500, land $20,000. You have your accounts payable, the liability, and your equity. So that $5,000 that the owner withdrew from the business, here you see the withdrawal, $5,000. Again, the accounting equation is in balance. Your assets is equal to liabilities plus equity. Here in this exhibit 1.5, it shows the 9 accounting transactions that we discussed earlier, and it provides a summary for the ending account balances. So notice that assets is $30,500 equals liability plus equity, $30,500. So the first transaction was Smart Touch Learning received $30,000 cash and gave cash, which is capital actually. The second transaction is when the company paid cash of $20,000 for land. Okay, so you see cash decrease. Now the balance there is $10,000, but you have land. Capital still remains the same. Transaction 3, the company bought $500 of office supplies on account. So you have the office supplies account and then accounts payable because they purchased office supplies on account. Transaction 4, received $5,500 cash from clients for service revenue earned. So you have $5,500 on the left, $5,500 on the right. 5, perform services for clients on account of $3,000. Here you see accounts receivable on the left, service revenue on the right. Transaction 5, perform services for clients on account, $3,000. So you see your office receivable, $3,000, $3,000. 6, paid cash expenses, office rent, $2,000, and employee salary, $1,200. Okay, so you see the $3,200 total cash, and then you see the rent expense, salary expense. 7, $300 paid on accounts payable, created in transaction 3, right here. So you see the 300 here, 300 here on the right side, accounts payable. So now accounts payable is decreased by the $300, so the balance in accounts payable is $200. 7 or 8, collected $2,000 on accounts receivable, created in transaction 3. You have your $2,000 where your cash is increased. Now the balance in cash is $14,000. Accounts receivable is decreased. The balance of accounts receivable is $1,000. Office supplies $500. Land $20,000. Okay. And 9 is owner withdrew $5,000. So now your cash is decreased. So the balance in cash is $9,000. Balance in accounts receivable is $1,000. Balance in office supplies is $500. The balance in land is $20,000. That will give you your $30,500. Here on the right side, you have your $200 liability, capital $30,000, withdrawals $5,000, service revenue $8,500, rent expense $2,000, and salary expense $1,200. So your left side is equal to your right side, and that is the accounting equation. The accounting equation is in balance. So this is the end of Learning Objective 4. Learning Objective 4. In our next video, we will go over Learning Objective 5, Preparing Financial Statements. Prepare financial statements in Learning Objective 5. Stay tuned. Thank you for watching. And please, if you haven't already, please click the subscribe button below. And also look out for our next video. Thank you for watching.